Do you want 3 to 4% interest rates on your next purchase? Let me show you how you can do it with subject to financing. Welcome to the Homebuyer Town Hall, San Diego. I am John Costigan with San Diego Real Estate Connection. I can be reached at 619-990-3044. My license number is 01004388. Today we'd like to talk about subject to financing. It's a method in which I've used quite often in buying my rental properties and other properties that I have acquired over the years. There's a lot of advantages to this and a couple of disadvantages which we'll go over. I think that for a person who wants to invest or is buying a property, this is a great opportunity in this market. What is subject to financing? Subject to financing is shortened from subject to the existing loan, meaning that when you're taking over a loan from somebody else, you're not notifying the lender of that takeover. You're just taking over and making payments in exchange for the property. That makes it a lot easier to, without qualifying for the loan and actually taking over their interest rate on their existing loan. Is this type of financing illegal? No, in most states it is not illegal to take over somebody's loan, but it is a breach of contract. Let's go into a little bit of definition on the two. The law doesn't say that you can't take over somebody's financing, but in a breach of contract, the owner of that loan or the lender has certain rights. One of the rights they have would be to call that note due and payable, meaning that they could basically foreclose against you if you take over the loan. I've done a bunch of these and that has never happened to me. Most of the time, the lenders want the payments more than to keep the loan in the same name. And in certain states, they have regulations against it. I know Michigan does, but most states will allow you to do this without it being a major problem. Whose credit is affected when you take subject to financing? It's the seller or the person who is on that loan. Since the lender's not being notified, any credit in which is accumulated based on that loan will be on the person who has the loan, not the person that's actually paying. So that's a consideration for both the seller and the buyer, which we'll go into shortly. Why would a seller want to use this type of financing? If they have a loan that's in default, this is a perfect use of this because it's a win-win-win. The buyer wins because the buyer gets an existing loan that they're not qualifying for. The seller wins because they're getting a loan paid that they're unable to pay. And the lender wins because they're getting the loan paid for that otherwise they'd be putting through a foreclosure process. The second reason is the seller can get a higher price for the property than what may be the current market because the buyer may not be able to qualify for that loan. Other than that, that loan is probably at a lower interest rate than the loan that the buyer would be able to get on the current market. I've got an example here I'd like to run through. On a $500,000 loan at 3% would be approximately $21,802 principal and interest based on a 30-year loan. The same loan would be $2,997.75 at 6%, which is where the current market is right now. So the buying power of the buyer last year has decreased by $148,000 over the year because of the increase in interest rates. Or the buyer would now qualify for only $351,600 instead of the $500,000 they qualified for last year. This is going to put pressure on the fair market value of the home. And that's one of the biggest reasons why I think we're going to be using this financing in the future. This also, depending on the equity that the seller has, we may be able to use another tool, which is a wrap loan. A wrap loan is where you're wrapping one loan inside of another loan at a slightly higher interest rate. So they may be able to arbitrage that loan. This is the reasons why a seller may want to use this type of financing when selling their property. Why would a buyer want to use this type of financing? They may not qualify for the loan. They may be self-employed. They may have a different problem in there, but they may be able to make the payments quite well. The only caution I put in there is that under Dodd-Frank, you have to prove ability to pay if you're going to own or occupy. If it's an investment property, that won't apply. You also probably will get a lower interest rate. The interest rates have increased significantly over the last year or so. So that's your second reason. A third reason is so that the loan does not show up on your credit. If you're an investor buying multiple properties, the banks start looking at you differently when you get over 6 or 7 properties that you have financing on. And then it not showing up on your credit gives you the ability to use your credit someplace else. All of these things work to the advantage of the buyer when they're doing this. So it's a consideration for a seller and a buyer when these are win-win situations. What are the risks to the seller? What if the buyer doesn't make the payments on this loan? There are methods to set up using a wrap method so that if the buyer doesn't make payments, then the seller can proceed with foreclosure against the buyer on the property. That's the first thing. What if the lender calls this loan due and payable, which they have the right to do? If the lender calls the note due and payable, in the contracting, there should be either one way or another to avoid this. And one of them is to have private financing in the background should you need it. Another method is a pre-arrangement that the buyer will be forced to put the property on the market if the note is called due and payable. These are just a couple of the ways that things are done in the creative finance arena. What if the seller wants his credit and it's tied up with the loan? This is one of the things you sort of give up when a seller does subject to financing. They are going to have a loan against them, which is a home loan for a period of time, and that time can be limited. You can put a balloon clause in there that will force them to refinance at some time in the future. And then structuring the loan, which is sort of what we've gone into a little bit, is how you put these together. And you really want to have a professional who knows what they're doing and possibly run this by your attorney to make that work. So those are the risks to the seller. What are the risks to a buyer who's buying a property using a subject to loan? Some of them are quite similar to the seller. The first major one is, what if the lender calls this note due and payable? You need to prepare for this in advance. You need to know that you'll probably have to get either a bank loan to pay off this loan, or you'll have to use private financing, or you'll have to be prepared to sell the property. Those are the three majors on that one. What if you're making the payment to the seller and the seller isn't making the payment to the bank? That one's easily cured by having a servicing company receiving the payments and have those payments made directly to the lender. There are also some paperwork that needs to be done on insurance and your ability to get information on this loan by using an authorization to represent or a power of attorney if necessary. So those are your risks to the buyer. Using professionals to help you in this process is necessary. If you don't know this process, it's one that can get you into a lot of trouble if you don't use professionals. I am open to talk to people about different methods. I do creative finance. I also suggest that you have an attorney working with you. As a disclaimer, I am not a real estate attorney. I am a real estate broker and investor. And I've helped a lot of investors buy property using these methods. I have never had one called due and payable, and neither have my other clients. But it is a risk in which you assume when using this type of financing. Thank you for joining us in the Homebuyer Town Hall. My name is John Costigan, and I can be reached at 619-990-3044.
The Power Is Now Media is worldwide with growing audience of future homebuyers, investors, builders, developers, real estate agents, and brokers. The Power Is Now Media is well positioned to increase awareness and produce results for our growing roster of advertising partners. An advertisement on any of our platforms is the right step toward reaching and communicating key brand messages to a targeted network of individuals, families, and communities interested in housing. Our content areas include feature stories and profiles on successful real estate agents, business owners, government, and community leaders. The Power Is Now magazines are the leading resource for real estate agents, mortgage bankers, entrepreneurs, and small home ownership businesses, providing leaders with business strategy information, resources, and tools through PIN, real estate, and programming guide magazines. Stay up to the minute with real estate and mortgage news and information from industry experts. VIP agents are able to feature listings each week. The Power Is Now TV radio podcast features weekly shows that include Homebuyers Town Hall, Real Estate Roundtable, VIP Agent Spotlight, and so much more. Each week, VIP agents have opportunities to be featured guests on the shows. VIP agents can discuss and showcase houses, neighborhoods, and provide brief introductions. The interviews are unlimited 10 to 15 minutes on each current listing. This product alone separates you from your competition. The Power Is Now delivers to you market update interview to promote listing weekly, promotional biographical video, co-host a bi-monthly Homebuyers Town Hall show, featured subject matter expert on Real Estate Roundtable show, The Power Is Now Program Guide e-magazine, The Power Is Now National e-magazine, article writing and blogging, social media content customization, inclusion and press releases, graphic design services, business and performance coaching, technology support, referrals, lead generation opportunities, and management support.